Hello to everyone. I am Nicolas Bornozis, President of Capital Inc., and it is our pleasure to welcome today Mr. Aristidis Alafouzos, the CEO of Okeanis Eco Tankers. Okeanis Eco Tankers is a leading international tanker company specializing in the seaborne transportation of crude oil. The company is listed on the Oslo Stock Exchange under the symbol OET and on the New York Stock Exchange under the symbol ECO. Now, before we begin, please note the usual disclaimer that this discussion is only for informational and educational purposes. It should not be considered as investment advice or advice of any kind, or an offer to buy or sell securities. And Capital Link obviously bears no responsibility for the content. And I'd like to mention as an additional disclosure that we have the privilege to work with Okeanis Eco Tankers on investor relations. Now, Aristidis, thank you for joining us today. We look forward to your insights on market trends, the Okeanis strategy, fleet operations, and growth plans, as well as your financial outlook for the company and the sector outlook. Let's begin our discussion with market trends and strategy. You mentioned in the earnings call that the expanded sanctions framework has significantly improved the market. So how do you see this trend evolving, and what impact do you expect to have on Okeanis operations in the coming quarters?
And firstly, Mr. Bornozis, thank you for inviting me and for the Capital Link team to invite me on and organizing this webinar. I appreciate it very much, and I hope it's useful for the viewers. To begin answering your question, I think assessing freight expectations based on sanctions, which are, they're completely politically driven, is quite complicated. The Trump campaign basically on establishing peace in Ukraine, being tough with Iran. He also campaigned on lower oil prices to benefit the U.S. consumer and drive down inflation, while also increasing U.S. fuel, fossil fuel production, as he was quoting, "drill baby drill." So this alone has many moving parts and conflicting theses. In slightly over a month, we have seen Trump push aggressively for a peace deal in Ukraine and reestablish relations with Russia. The war in Ukraine was the fuel of the tanker rally starting in February 2022. The massively positive impact we saw on freight from the Ukraine conflict arose from the EU banning seaborne imports into Europe, and not from sanctions on Russian oil and gas industry or the price cap initially. The Russian exports, as we've discussed many times, they were being sold primarily into the EU, and now they were doing triple or quadruple the distance going to India and China, which is very positive for ton-mile demand. While European imports also increased in distance, with more US, AG, and West African crudes displacing the lost Russian. I guess a bearish scenario is if the EU quickly accepts to import Russian crude oil, which I don't consider likely at all, but it's not impossible either. In a potential US-driven peace deal in Ukraine, we could see softer US sanctions, which would allow foreign companies to reinvest in Russia. I assume mostly American companies and non-European companies. I also think that the Trump administration would dissolve the price cap and allow the entire Russian trade to use the dollar as a trade currency. I consider this quite a likely scenario. Western compliant actors would re-engage to a larger percentage in this trade and the transport of the Russian crude oil and products. Again, I think this is a positive. And because in my base case scenario, and how I see things, the EU ban will continue for imports, these products and crude oil continue delivering into India and China. This would force the oldest segments of the shadow fleet to be phased out of the trade and become useless, in my opinion. A large percentage of that fleet is over the age of 20 and run by questionable operators who shun maintenance, safety regimes that we in the normal fleet invest heavily in and strictly adhere to and are audited by. This Russian trade mostly impacts Aframaxes, Suezmaxes, and the entire clean sector. This scenario, in my opinion, would be positive because it would create new ton miles for the compliant fleet, while the shadow fleet becomes marginalized. And if the entire Russian trade, for example, is transported only by Western tonnage, this would more than offset the incoming order book on Aframaxes and Suezmax. So I think that just to recap that part, I think a US-driven peace deal where EU maintains the import ban, but US allows Western companies to transact into Russia is actually positive for the tanker fleet. And until today, Trump hasn't focused on Iran very heavily. He signed a couple of executive orders, he wrote them a letter, he made some comments that a nuclear Iran is not acceptable. And members of his cabinet have been a bit more outspoken and said that we have to establish a maximum pressure policy. We've seen a few sanctioning of some ships and trading companies and brokerages who are involved in the Iran trade, but nothing that we consider maximum pressure yet. And his cabinet has also expressed that they want to reduce exports basically to zero and reduce their access to foreign currency. I think that Trump is simultaneously dealing with many issues that could potentially drive up oil prices. And he's very cautious at the same time on taming inflation. So the application of maximum pressure on Iran needs to be done carefully in order to not drive up oil prices. I do believe Iran is very much still on the agenda, though, especially given the close relationship with Netanyahu and Israel. Iran exports are almost exclusively sold to China. If China is unable to import Iranian barrels on their ghost fleet or shadow fleet, they'll have to offset this by non-sanctioned crude on non-sanctioned vessels. The benefit will be huge for the VLCC freight market. A reduction of around 1.5 million barrels per day of Iranian exports would create demand for over 45 VLCCs, lifting substitution crudes, which would have a massive impact on earnings. This would signal the beginning of the VLCC super freight cycle, in my opinion. And it's what's extremely interesting, and I also think very likely, and the driver of the VLCC market. Overall, the sanctions regime, in my opinion, will continue to benefit the ship. I believe the most upside is on the VLCCs and coming from this. And this will give opportunity to Okeanis to capture the sudden imbalances of crude procurement for the major receivers. Thank you for that question.
Aristidis, thank you very much. This has been a tremendously thorough reply to the question. Thank you very much for this amazing insight. Now, let me go to the next question. Fleet positioning has been a key differentiator for Okeanis. What is your approach to strategic vessel deployment, and how has this contributed to your outperformance compared to your peers?
Thank you for the question. Well, I mean, fleet positioning is something that we really care about. It's also it's where I started my career in spot chartering in this company. So it's very important to us to perform well commercially, and it's something very close to the way that I grew up professionally as well. OET has a relatively small fleet when you compare it to Frontline or Trafigura or Sinacor. And this can have benefits or weaknesses. Generally, if you have a small fleet of 2 or 3 ships with a small footprint on a vessel segment that actually has quite long voyages, and you end up fixing few cargoes per year. And this has issues because it may be difficult to develop a close relationship with charters. So you end up, just being a ship on the position list that if things are a bit tighter, they'll come to you, but generally you're not the first choice. But most importantly, you may not have the presence to catch the spikes in the market that could be short-term and volatile. And we know that tankers are extremely volatile, and sometimes the spikes are quite short-lived. So having a big enough fleet to have good relationship with charters, but more importantly, to have the presence to capture these spikes is very important. and how we trade our VLCCs and Suezmaxes. So, if we decided that we wanted to have exposure to every market, and we traded our ships in every market, and then had no trading strategy, I think that would be a big impediment, both to our VLCC and Suezmax earnings. Instead, we sit down with our chartering team, and we look at a few different strategies that suit our fleet, and we focus on these. If they work and outperform the benchmark index and our competitors, we stick to them, and we focus on becoming really reliable partners to our charters. So when then one of our competitors wants to break into this trade, we've already established that very good working relationship. It's important that our charters know that we're consistent and efficient in our service, because then they give us preference going forward. So we really do care about the service we provide, and we ensure that it's top quality. And I really think that top quality service is something that you can achieve by having your own technical management. Often when you outsource technical management, especially to a technical manager that has 1,000 ships and you're 20 ships in that fleet, it's very difficult to have the same level of quality. An example is on the Suezmaxes in how we trade. We focus on trading in the West and in the Mediterranean. We have our relationships, since my father was doing spot charting in the 1980s with some of the oil companies that we've kept over the years, and we cherish and value these positions. The voyages are quite short as well, so if the market is volatile, the ships open quickly in order to capture it. And if we think that the market might fall, we always have the option of doing a longer voyage or shorter voyage, depending on how we see things. Another benefit is because the voyages are short and the ships circulate quite quickly, we can always swap around our own ships in order to optimize around cargoes and maximize earnings if one delays or if another one opens early. On the VLCCs in this current market, we really enjoy triangulating by fixing backhauls, whether it's with a cleaning up the ship that's opening in the east and loading diesel from the Arabian Gulf to Europe, or finding a backhaul with crude from West Africa or Brazil or the AG to Europe again. And then the following voyage will be a front haul from the US Gulf or Brazil or the North Sea back east. And that's how we triangulate and minimize balance. We have seen that this consistently outperforms the round voyage market, and it allows us also to fix more voyages throughout the year. And that grows our footprint that I mentioned earlier. So we're able to capture more spikes. This may have an impact from time to time on our quarterly earnings, as we may have fixed a large number of backhauls. So we might have a lot of our ships on lower earning backhauls. And that impacts, because the earnings are lower, or we also maybe get impacted by the smaller fleet we have due to IFRS accounting standards. But generally, it's the case, we don't really focus on quarterly earnings. We focus on annual or overall earnings, and we protect the business as a business, and we don't focus short term. I hope I answered the question.
I do, and I do appreciate actually your focus on the sustainable longer term performance rather than the quarter by quarter, which I think is a very important statement to make, that you're in this business for the long haul, not just quarter by quarter. Now let's go to the next question. With the crude tanker market supply tightening due to an aging fleet and low new build orders, how do you see the competitive landscape shifting over the next few years? And particularly, what role does Okeanis' modern fleet play in this changing market? I'd like to remind our listeners and viewers that you have 14 vessels, modern, average fleet age 5 years, all scrubber fitted. So I know that this is a major competitive advantage, the modernity and efficiency of your fleet. So how does it play in your operations and strategy?
Yeah, thank you for the question. Well, on the order book, I wish the order book was a bit lower for the smaller sizes, although it doesn't impact Okeanis as much. But the Aframax and LR2 order book is quite large looking at a historical basis. The Suezmax is not as large as LR2s and Afras, but it's a bit bigger than we'd like ideally. but we're very happy that the VLCC order book is still below 10%. But as you mentioned, we do have a lot of mitigating factors that, the headline number of an order book might be quite large, but if then you bring in the age profile of the fleet, it really doesn't seem that it's even a sufficient order book. The fleet age profile, especially on the largest sizes of vessels, is very attractive. By 2027, when the order book for Suezmaxes and VLCCs have mostly delivered, so that's in 2.5 years from now, towards the end of 2027, 35% and 30% of Suezmax and VLCCs respectively will be over the age of 20. This is generally the age where ships become commercially unworkable for almost all normal businesses. There's some ships that may be able to work here and there over 20, if it was built by a reputable owner and kept for 20 years under one ownership. And still the ship will have huge decreases in the efficiency of its trade. But if the ship has had multiple owners and it's ending up with a tier 2 owner, it's effectively unworkable in normal markets. If we go 1 year further out into 2028, 50% of the Suezmaxes are over 20, and 42% of the VLCCs are over 20. These are huge numbers, and I don't understand. I don't see it possible for the order book to be able to substitute for all these aging ships. So for us, it's very attractive. The size of the order book today on VLCCs is half of the percentage of VLCCs turning 25 in 2028. So, these are huge. I mean, I wouldn't even call them mitigating factors. I would call them factors that will extend the cycle going forward. In between the period of these vessels really hitting the 20 age mark, where, it's the orders from 2007, 2008, 2009, and where those really start growing quickly, I do see some scenarios where on the smaller side of the ship, that things could soften a little bit. But I really do think this will be a short-lived softening, as we have this tsunami of elderly tankers coming in. Talking a little bit about scrapping, unfortunately, a 20-year-old ship doesn't get scrapped automatically. As I mentioned earlier, it can continue to service some normal trades, but with a lot of difficulty and extremely low efficiency. It can move into some kind of peripheral shipping trade, like become a floating storage unit, or it can move into the shadow fleet. Due to the size of the shadow fleet, I think that scrapping in mass will be quite difficult. And just because of the supply of vessels coming in. And the shadow fleet owners are not established, and I don't think they're accountable ship owners either. And we've seen that in some of the recent cases where there have been incidents and the vessels have been abandoned. I do expect that some of the shadow fleet just to be abandoned at anchorage instead of being scrapped. And therefore, going forwards, I think we shouldn't only look at scrapping as a sign of fleet balancing, but also, long-term idling. And I think that will become a lot more prevalent in the future. Another interesting factor that you touched on is that currently we have no Chinese tonnage. If Trump and the U.S. administration continues to try and counter Chinese shipbuilding, the levies will make the Chinese tonnage uncompetitive to call in the United States. On the VLCC segment, 25% of the fleet is Chinese built, and the order book is 79% Chinese built. So this could be quite a large impacting factor for, let's say, how the fleet is split, and if the Chinese tonnage isn't able to go to the west because the United States is the biggest loading area and people will shun away from there and they focus on the east, there could be another imbalance in west and east markets. And given that we always like to trade our ships in the west, hopefully it could be something that we can take advantage of. So Okeanis is in an excellent position due to our young fleet, Korean and Japanese fleet, and being fully delivered. And we also think that in these volatile times, it's really important to have a fully delivered fleet. because the opportunities may be short-lived, whether for spot, time charter, or sales.
Thank you very
Thank
much. Thank you. So now let me move to the market itself. The crude market was softer in Q4 than expected, but you mentioned that the first quarter of 2025 has started on a stronger note. So what factors have driven this turnaround, and how do you see this momentum continuing into the second half of the year?
Thank you. The turnaround at the beginning of this year was driven by Biden's last OFAC sanctions, which were placed on a large number of Russian and Iranian shadow fleet. It was evident that this caused a lot of concern in China and India and Turkey and led them to diversifying their crude purchases. So that there was insecurity about further sanctions, and the Chinese and Indians and the Turks, they understood that. And this led to an increase in cargoes being purchased from compliant sellers, which use Western tonnage. We saw a lot more buying of spot crude from the Arabian Gulf, which was very evident if you look at the spike in the Brent-Dubai spread. And this purchasing continued with substantial volumes also coming from WAF, Brazil, and the US Gulf. And we continue to see that today. We continue to see that the Chinese and the Indians are diversifying their imports to a large extent. We also see that they are not using, the Indians and the Turks are not using any sanctioned tonnage. The Chinese are, I think they're able to get some in on sanctioned tonnage. They're also using some STS to hide the origin of the cargo and the origin of the ship bringing the cargo in. But this is expensive and difficult, so it's inefficient. With regard to the strength in the sanctions driving us in early Q1, this relies on US policy. Previously, under Biden, sanctions were not strongly enforced, although they were in place. If the Trump administration enforces sanctions, and they also have a further tool to use called the SHIP Act to further pressure sanction breaches, we will see a lot more strength in this market. And this is a huge potential driver for tankers. I think the rhetoric on Iran has been consistent from Trump. He is a hawk, and he has good relations with Israel, as I mentioned. And given that he's so competitive, I'm sure that he's annoyed that the Chinese are buying discounted crude from them. And, it's an unfair advantage. So for me, it's not a matter of if, but when things tighten with Iran. I really do think the Iran squeeze is around the corner. And Trump and his team, they do have other big issues like this ceasefire and the peace agreement in Ukraine. Once there's a bit of a path there, I think they'll pivot and, as Trump would say, make freight great again, make TD3 great again. And additionally, Trump stated multiple times, as have members of his cabinet, that they will want to refill the SPR. The SPR needs heavy crude, while the recent boom in US production and shale production is light. The US refiners also require heavier crude. So the US crude is not adequate for its own refineries, let alone the SPR. The local heavy crude production from Canada, Venezuela, and Mexico also will not be adequate for the volume to refill the SPR. In order to refill the SPR over the next 2 years, for example, we would need around 1,200 barrels per day. That's an additional VLCC every 1.6 days delivering crude into the United States Gulf. And where would the source of this crude come from? The AG, in my opinion. That's the one place in the world where OPEC has spare capacity, and it's the right type of grade with heavier grades coming out of Saudi, Oman, and various other, Iraq, Kuwait. And I think that's another very bullish driver on top of sanctions, the potential SPR refill. Thanks.
Thank you. I'm sure everybody knows that SPR, that Aristidis is referring to, the Strategic Petroleum Reserve that the government keeps on reserve available all the time. So Aristidis, I think you answered the next question that I have on sanctions, but let me ask it again, just in case you would like to add something more. Sanctions have led to a growing divide between compliant and non-compliant fleets. And how do you ensure that Okeanis remains well positioned in this environment? And how do you see any further regulatory shifts impacting the target market? You already alluded several times to the sanctions, but if you have anything else to add on this before I move to the next one.
Yeah, thanks. Well, according to the data, like to some services, we know that there's about 234 tankers that are currently sanctioned that are involved in the Iranian trade. The tools we have show us that there's another 288, so more than double the amount sanctioned, that are involved but yet to be sanctioned. And as I mentioned multiple times, I strongly believe that it's this administration's intent to limit Iranian exports and enforce sanctions, as we just discussed. From the perspective of the US government, whether it's Iranian, Russian, or Venezuelan barrels, they're all cheaper than what crude can be procured by the Americans, and therefore an unfair advantage to them. If there are sanctions in place, they will be enforced to limit this advantage. And as my earlier comment, our modern fleet and relationships with charters put us in a prime position to take advantage of that shift in demand for cargoes to be transported by the compliant fleet instead of the shadow fleet. Because if you end up stopping sanctioned trades, whether from Iran or Venezuela or Russia, the countries who are importing these cargoes need to substitute, and the substitutions will be done with normal cargoes using normal ships, and that's the creation of new voyages, and that's really bullish.
Thank you. So now let's move on to the next question. You have successfully refinanced most of your fleet, improving margins and extending maturities. So how do you view your capital structure going forward? And are there any opportunities for further cost reductions or balance sheet optimization?
Yeah, we have been quite active over the past 18 months, and the market has been very attractive as well. So we did have quite a few opportunities to reduce our margins, extend maturities, and add a bit of flexibility to our capital structure. We spent time developing some new relationships, and that can be seen with our first step into the Taiwanese market. And we hope to expand that relationship with other Taiwanese banks in the future. We have two expensive legacy leases on the Riña and the Despotiko. Unfortunately, we have another 12 months until we have the option to refinance these. But once we do have them in 12 months, we anticipate that this will further reduce our cost and break even significantly. Until then, if we find other opportunities that we think are attractive, we will consider it. But we always need to take, account of fees and over the time horizon that we have, that these new fees and that we accumulate make sense both financially and strategically.
Aristidis, thank you. Let me move on to the next question on fleet operation and on growth strategy, basically. So you've demonstrated strong earnings power through your eco scrubber fitted fleet and your commercial strategy that you described. Are there any potential fleet expansion plans or modernization plans in the pipeline, or will you focus primarily on optimizing the existing fleet?
We had a few opportunities over the past 2-3 years to acquire some assets that would fit nicely in our fleet, but we didn't execute on this. In hindsight, it was a mistake. But we want to be careful with the risk reward assessment of each opportunity, and we're really not keen to grow at inopportune times and be saddled with expensive assets in a weak market and high debt. We have a young and efficient fleet, and we're lucky that this medium-term issue of an aging fleet is not a concern for us. It's going to allow us to be patient and wait for a more attractive entry and exit. Until then, our strategy has been and will be pretty straightforward. Trade the vessels as best as we can, take advantage of our commercial outperformance, and deliver that value directly back to shareholders, as we have done consistently over the years. From the point of view of an OET investor, OET does have leverage, and our dividend payouts have and will reflect that in strong market. Growing to grow was never a priority for us, unlike shareholder returns. And if we wanted to grow today, looking at how we could do that, equity issuance would be diluted. Pure debt funding would be reckless, while ship for shares is difficult to find. We're going to continue looking for interesting opportunities and hope we find some, but we will be consistent in how we behave in the future as we have in the past. Thanks.
Actually, thank you very much. So as a concluding remark, you've answered in terms of how you position your company to maximize shareholder value, but are there any concluding remarks regarding the market outlook, your company strategy and positioning? Thank you, by the way, for our discussion today. It has been particularly thorough, and I appreciate the fact that you shared a lot of factual information with us, which makes exactly the how authoritative and insightful is this podcast.
I'm glad, and I hope your subscribers find it as useful as well. To conclude, I think, as I mentioned earlier, as Okeanis and how we look at the market, we have some strategic and tactical strategies we employ. If we make the correct choices going forward, we'll continue to outperform. We have the right fleet and the right team to get the most out of the medium and the short term, so I'm really optimistic. Due to our young fleet, we have no need to pour cash for a fleet renewal, and that will allow us to continue paying a large percentage of our profits out to our investors. The market at the moment is steady at current levels. I feel that fundamentally it is quite tight, but we just need that spark to really drive it forwards. I do think it will come, and especially I think that we could have a very strong market, whether the United States does decide to proceed and refill the strategic petroleum reserve, when it makes a move on squeezing Iranian exports, and as long as Europe doesn't decide to start importing Russian crude again. So I think these three drivers have huge potential for the market. I think they're very likely, and I'm looking forward to the rest of this year and waiting for it to play out. Now, we're definitely positioned and excited as well. Thanks for the question, and I really appreciate this discussion, Mr. Bornozis.
Thank you very much, Aristidis, for sharing your insights with us today. It has been a pleasure discussing with you on Okeanis' market strategy, fleet operations, financial outlook, and sector outlook. So for those of you who would like to revisit this conversation, please note that this interview will be available to access upon demand at www.capitallinkwebinars.com and also on Capital Link's YouTube channel. Thank you to everybody for joining us today. We look forward to our next podcast. And Aristidis, thank you again.
Thank you very much. I hope to see you soon, and the team. Bye-bye.